Want to know how to use moving averages and trendlines in Forex trading? You're in the right place. Welcome to the fascinating world of Forex trading, where understanding patterns and trends can turn the tide in your favor. Today, we're going to demystify two crucial tools in your trading arsenal: moving averages and trendlines. Let's begin with moving averages. These are used to identify the direction of a trend and smooth out price data by creating a constantly updated average price. It's like viewing the forest from above, rather than getting lost amongst the trees. They help you ignore the noise and focus on the overall direction. In essence, moving averages help traders spot trends and forecast future price movements. Next up, we have trend lines. Picture a line that you draw on a graph, connecting the swing highs in a downtrend or the swing lows in an uptrend. This is your trend line. It helps traders visually see a market trend and provides areas of support and resistance, which can be incredibly helpful when deciding when to enter or exit a trade. Now, you might be wondering, why are these tools important? Well, in the unpredictable world of Forex trading, they offer a semblance of predictability. They allow traders to identify market trends and potential entry or exit points, aiding in making informed trading decisions. Consider this: you're navigating through a dense forest with no clear path. Wouldn't a compass and a map be handy? That's exactly what moving averages and trendlines are to a trader. They provide a sense of direction and a roadmap to navigate the ever-changing Forex market landscape. Understanding these tools and how to use them effectively can be a game changer. Whether you're a seasoned trader looking to refine your strategy or a newbie dipping your toes in the Forex waters, mastering moving averages and trendlines can give you a significant edge. So, ready to dive into the world of moving averages and trendlines? Let's get started. First, we need to understand what moving averages are. In the world of trading, moving averages are a fundamental tool used to smooth price data and identify trend direction. They do this by averaging the closing prices over a defined period of time, hence the term moving averages. Imagine the ocean waves. Sometimes the waves are high and other times they are low. But if you could average out the height of the waves over a period of time, you'd get a smoother, more consistent line. That's essentially what a moving average does for price data. It smooths out the highs and lows, the ebbs and flows, to give you a clearer picture of the overall trend. Now, there are several types of moving averages, each with its unique calculation method and purpose. The most common ones are the simple moving average, often abbreviated as SMA, and the exponential moving average, or EMA for short. The simple moving average is just that, simple. It calculates the average price over a specific period. For instance, a 10-day SMA would average out the closing prices of the last 10 days. On the other hand, the exponential moving average gives more weight to recent prices. This means it's more responsive to recent price changes. If our 10-day EMA sees a significant price drop on day 10, that drop will have a more profound effect on the EMA than it would on the SMA. But wait, there's more. There's the weighted moving average, the smoothed moving average, and many more. Each of these has its own calculation method and purpose, but they all share the same goal: to help traders identify trend direction and potential entry and exit points. So, to sum it up, moving averages are a way to smooth out price data and identify trends. They come in many shapes and sizes, from the simple to the exponential, and each has its own strengths and weaknesses. Now that you have an understanding of moving averages, let's move on to trendliners. Next, let's talk about trendlines. Trendlines are a fundamental tool in technical analysis that help traders visualize the trend and predict future price movements. They connect a series of highs or lows, forming a line that can be upward, downward, or even sideways. Think of them like a line in the sand that separates bullish and bearish territories. So how do you draw a trend line? Well, it's simple. In an uptrend, you connect the higher lows. This creates an ascending trend line that acts as a support level where the currency pair may bounce off and continue its upward journey. In a downtrend, you connect the lower highs, creating a descending trend line. This line acts as a resistance level where the currency pair might bounce off and continue its downward trajectory. The more times the price touches the trend line without breaking it, the stronger the trend is considered to be. Now, you might be wondering, why are trend lines significant? Well, a trend line not only helps identify the trend's direction, but also its strength and potential reversal points. A break above a descending trend line can signal a shift from a downtrend to an uptrend. Similarly, a break below an ascending trend line can indicate a potential shift from an uptrend to a downtrend. But remember, trend lines are not foolproof. They are just one piece of the trading puzzle. It's crucial to combine them with other technical analysis tools for a more comprehensive trading strategy. Trend lines can be subjective too. Different traders might draw different trend lines on the same chart. So it's important to practice and develop your own style and interpretation. To sum it up, trend lines are a simple yet powerful tool in Forex trading. They provide valuable insights into market trends and potential reversal points, helping traders make informed decisions. With a clear understanding of trend lines, we can now delve into how to use these two tools in Forex trading. So how do you use moving averages in Forex trading? Well, moving averages can be your best friend in the dynamic world of Forex trading. They're like a magical compass, helping you to navigate through the sea of market volatility. To start with, choose a time period for your moving average. This could be anything from 5 minutes to 30 days, depending on your trading strategy. The time period you select will determine the sensitivity of the moving average to price changes. Shorter time periods will be more sensitive, giving you a closer view of the market's minute-by-minute movements. Longer time periods will be less sensitive, smoothing out short-term fluctuations to reveal the underlying trend. Once you've chosen your time period, calculate the average closing price over that period. This is your moving average. Plot it on your chart and watch as it moves along with the market, like a shadow following its master. Now let's get to the fun part, using your moving averages to identify trends and potential entry and exit points. If the price is above the moving average, that's a bullish signal. It suggests an uptrend and might be a good time to buy. If the price is below the moving average, that's a bearish signal. It indicates a downtrend and might be a good time to sell. But remember, moving averages are lagging indicators. They're based on past prices, not future ones. So they're best used in conjunction with other indicators to confirm trends rather than predict them. Also, keep in mind that moving averages can't tell you everything. They're just one tool in your trading toolbox. Use them wisely and they can help guide your trading decisions. That's how you utilize moving averages. Now, let's talk about using trend lines. Now let's discuss how you can use trend lines in Forex trading. Trend lines are a fundamental tool in Forex trading. They're used to illustrate and identify the direction of a trend. But trend lines aren't just about drawing lines on a graph. They're about understanding the market psychology and anticipating potential price movements. To start using a trend line, find at least 2 significant points on a chart. These could be peaks or valleys, depending on whether you're charting an uptrend or a downtrend. Once you have these points, draw a straight line that connects them. This is your trend line, and it gives you a visual representation of the trend's direction. Now let's talk about entry and exit points. When the price approaches your trend line, pay close attention. This is where the market tests the trend. If the price bounces off the trend line and continues in its original direction, we call this a validation. A validated trend line can be a great place to enter a trade in the direction of the trend. But what if the price doesn't bounce? What if it breaks through the trend line instead? This could signal a trend reversal. It might be time to exit trades that rely on the continued trend and potentially look for trades in the opposite direction. Remember, trend lines aren't foolproof. They're tools to help you read the market, not crystal balls that predict the future. So always use them in conjunction with other technical analysis tools and indicators. One more thing, trend lines can be subjective. Different traders might draw different trend lines on the same chart. That's okay. What's important is that your trend line makes sense to you and helps you make informed trading decisions. That's how you apply trend lines. But how do you use these two tools together? The real magic happens when you combine moving averages and trend lines. We're now at the heart of our journey, where we'll explore how moving averages and trend lines, two powerful tools, can be integrated to refine your trading strategies. This combination allows you to identify stronger trends and make better trading decisions, which is, after all, the ultimate goal. Imagine moving averages as your compass, guiding you through the vast ocean of Forex trading. They provide you with a sense of direction, smoothing out price fluctuations, and revealing the underlying trend. On the other hand, trend lines act as your map, marking important price levels and potential areas of interest. When used together, these two tools can offer valuable insights. For instance, a moving average might show an upward trend, but what does the trend line tell us? If it's also moving upwards, this could indicate a strong bullish trend. This dual confirmation can boost your confidence in the trend's strength and longevity. Similarly, if the moving average is declining and the trend line is also sloping downwards, this could suggest a bearish trend. Again, having both tools in agreement can give you more assurance about the trend's direction. But what happens when the moving average and trend line contradict each other? This is where things get interesting. A disagreement between these two might suggest a potential trend reversal. It's like a red flag waving, telling you to be cautious. This could be an ideal time to tighten your stop losses, or perhaps even consider exiting the trade. Of course, as with any trading strategy, there are no guarantees. The combination of moving averages and trendlines is not a silver bullet. It won't always predict market movements with perfect accuracy, but it's a valuable tool in your trading arsenal, helping you to make more informed strategic decisions. Remember, the key to successful trading is not about predicting the future. It's about managing risk, staying disciplined, and making well-informed decisions. And that's how you combine moving averages and trendlines for a more effective trading strategy. Let's recap what we've learned today. We've delved into the world of Forex trading and discovered how two powerful tools, moving averages and trendlines, can enhance our trading strategies. We started by introducing moving averages, a simple yet powerful tool that helps us to identify the overall trend in a market by smoothing out price fluctuations. We learned that moving averages are calculated by adding up the closing prices of a currency pair over a certain number of periods, and then dividing by that number of periods. This provides a more accurate reflection of the market's overall direction and can be especially useful in volatile markets. Next, we turned our attention to trendlines. These are lines drawn on a chart to connect swing highs in a downtrend or swing lows in an uptrend, helping traders to visualize the trend and to identify potential reversal points. Trendlines can be a valuable tool in Forex trading because they provide visual representations of the market's direction, making it easier to identify trends and predict future price movements. We then explored how to use moving averages in Forex trading. We saw how they can be used to generate trading signals, with a buy signal being generated when the price crosses above the moving average, and a sell signal being generated when it crosses below. We also learned about the importance of choosing the right type of moving average, whether that's a simple moving average, exponential moving average, or weighted moving average, depending on your trading style and the market conditions. After that, we looked at how to use trendlines in Forex trading. We learned how to draw trend lines correctly and how they can be used to identify support and resistance levels, which are key areas where the price is likely to bounce or reverse. We also discovered that the more times a trend line is tested and holds, the stronger it becomes. Finally, we discussed how to combine moving averages and trendlines in your trading strategy. By using these tools together, you can identify stronger trading signals and improve your chances of making profitable trades. For example, if a price breaks through a trend line and then crosses a moving average, this could be a strong signal to enter a trade. It's important to remember, however, that while these tools can be incredibly useful, they're not foolproof. No tool or strategy can guarantee success in Forex trading. It's crucial to practice using these tools and to develop a solid trading plan that includes risk management strategies. With these tools in your arsenal, you're well on your way to becoming a more effective Forex trader. Remember, practice makes perfect. Happy trading!